Today, the R word is back in vogue. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, it's been another violent 24 hours on the markets in which stocks tumbled around the globe as recession fears resurfaced. And of course, that's because central bankers, including the Fed, have been struggling to get on top of inflation. It's proved to be more persistent and widespread than they anticipated. Remember, transitory? It begs the question, though, why should we have any confidence in the central banks at all, as their godlike powers to control Mr. Market and Mr. Economy are clearly broken? Perhaps we'll be better off without them. And elsewhere, as investors dumped European bonds and the franc rallied after a surprise Swiss rate hike, and the pound rose as the Bank of England raised rates and signals it prepared to unleash larger moves if needed. Currency option traders are betting the Bank of Japan will deliver a policy surprise this week, and more than 50 central banks around the world have raised interest rates by at least half a point in one go this year. And to add a touch of extra spice, China says that COVID lockdowns might well be in place next year. Now, as a result of all this mayhem, the S&P 500 closed at its lowest since December 2020, while the tech-heavy Nasdaq sank 4%. At the close, the Dow Jones declined 2.42%, to hit a new 52-week low, while the S&P 500 fell 3.25%. And because of the falls on the Nasdaq, down more than 4%, the deal spread on Elon Musk's proposed takeover of Twitter widened, as the billionaire hasn't directly asked and didn't address the issue of whether he'd committed to buying the social media firm during a recent staff meeting. In fact, Twitter was down 1.66% to 37.36. And the volatility index, which measures the implied volatility of the S&P 500 options, was up 11.24% to 32.95. Average long-term US mortgage rates had their biggest one-week jump in 35 years following the Federal Reserve's announcement this week, as it raised its key rate by 0.75 of a point. Mortgage buyer Freddie Mac reported on Thursday that the 30-year rate climbed from 5.23% last week to 5.78% this week. That's the highest it's been since November 2008, during the housing crisis. And home builders slid as mortgage rates jumped the most since 1987. Construction started on new US homes fell 14.4% in May. That's according to the Commerce Department. And the annual rate of total housing starts fell to 1.55 million last month from a revised 1.81 million in April. The drop is the biggest decline since April 2021, and housing starts are at the lowest level since April 2020, when the economy briefly fell into a steep recession at the start of the coronavirus pandemic. Nationwide, the US housing market appears to be slowing down, due in part, of course, to the Federal Reserve increasing interest rates. Home builders also have run out of windows and garage doors, and they weathered a spike in lumber prices. And the economists at Florida Atlantic and Florida International had some cautionary advice for buyers in other real estate markets they believe are overvalued. Those markets include Austin, Texas, Ogden, Utah, and Las Vegas, all of which they identified as being overvalued by more than 60%. And the authors added that just because a market is overvalued by 50 or 60% based on historical price movements, it doesn't mean it will fall by that amount, but they don't discount a painful wake-up call for buyers and sellers in those markets. And the dollar fell as central banks in Europe stepped up monetary tightening, promising to narrow the gap between rates there and in the US. And Treasuries rebounded from an earlier sell-off. Bitcoin dropped below 21,000 amid its longest slide since 2010. It was down 2.94% to 20,993, a day after slipping to an 18-month low of 20,076, amid a deepening market meltdown sparked by crypto lender Celsius this week freezing customer withdrawals. Declaring that it's essential to tame inflation, Jerome Powell engineered the biggest rate increase since 1994 on Wednesday and held out the distinct possibility of another jumbo hike in July. And while the Fed chief sought to soften the blow of the 75 basis point boost, saying he didn't expect such moves to be the norm, he tacitly admitted the chance of an economic downturn. We're worrying about growth and where the Fed takes us ultimately, said Chris Gaffney, president of world markets at TIAA Bank. Yesterday, everybody said, oh good, the Fed is doing something aggressive. They're going to get aggressive. They're going to try to catch up on the inflation curve. But now you're looking at it and saying, yeah, but are they chasing something they're not going to be able to catch? While inflation is out of control, the Fed is doing the best it can given its limited tools, Orlando Bravo, co-founder of private equity firm Thoma Bravo, said. Despite the stock carnage, valuations still have much further to fall, though, according to Jim Chanos, founder of Chanos & Company. The S&P 500 now implies an 85% chance of a US recession, amid fears of a policy error by the Fed, according to JP Morgan. The warning from quant and derivative strategists is based on the average 26% decline for the gauge during the past 11 recessions, and it follows its collapse into a bear market. One technical indicator of US stocks shows the extent of the recent slump, whilst at the same time offering a whiff of optimism that it will soon come to an end, maybe. The percentage of the S&P 500 members that are trading above their 50-day moving average sank below 5% this week. That's the lowest level since COVID-19 fears battered shares more than 2 years ago. Both that sell-off and the one that hit markets in late 2018 reversed course shortly after, seeing a similar share of stocks dip below the closely watched technical average. Our main takeaway from the Fed is hawkishness, meaning the Fed is going to accept recession risk to deliver below-trend economic growth, wrote Dennis Debauche, the founder of 22V Research. Concerns are mounting about whether the Fed is headed towards a policy mistake, said Quincy Crosby, chief equity strategist at LPL Financial, and despite their assurance, it's unclear to me whether the Fed has the tools they say they do to tamp down prices, said Jason Brady, chief executive officer at Thornburg Investment Management. Commodities may deliver breathtaking returns amid tight supplies and low inventories, according to JP Morgan. Returns could total 10% by the end of the Northern Hemisphere summer and 5% by the end of the year. And volatility will also stay elevated, the report said, with oil possibly touching $150 per barrel in the short term, while corn could reach $13 a bushel. That's a record price by a long shot. So I guess the question now is, well, how credible are central banks? Even after central banks recognised they got their inflation calls wrong last year, they've continued to fluff their policy guidance, which simply threatens greater damage to their credibility, roiling markets and undermining the pandemic recovery. In fact, Lowe's outing on ABC 7:30 this week is just one such example. And so that Federal Reserve hike of 75 basis points was just weeks after Chair Jerome Powell and his team repeatedly advertised a half percentage point move. It's the latest in a series of misfires, from deeming high inflation transitory last year to speeding up the end of its bond purchase program to accelerate the run off its bond portfolio. And European Central Bank President Christine Lagarde has lately also turned more hawkish than she previously indicated, and the Reserve Bank of Australia is among those, raising rates faster than policymakers had signalled. So investors are casting judgment as they fret that the race to make up for past forecasting errors raises the risk of recessions. Global stocks have entered a bear market. US Treasury yields on Monday posted their biggest two-day jump since the 1980s, and credit markets are showing signs of increasing stress. Dramatic bond market moves forced the ECB to hold an emergency governing council session on Wednesday after which the panel pledged to accelerate work on a new tool to address surging yields in some Eurozone member countries. The European Central Bank President also told Euro area finance ministers that the ECB's new anti-crisis tool will kick in if the borrowing costs for weaker nations rise too far or too fast. At a meeting in Luxembourg on Thursday, she explained to ministers that the new mechanism that central bank officials are devising is intended to prevent irrational market movements from putting pressure on individual euro nations as the ECB embarks on its first interest rate hikes in more than a decade. The euro rose 1.2% to 1.05. That's the highest level of the session on the news. And she said the instrument may be triggered if bond spreads widen beyond certain thresholds or if market movements exceed a certain speed, but they didn't specify what those limits or speeds would be. And the ECB Governing Council on Wednesday instructed officials to accelerate that work on the new anti-fragmentation instrument after the yield on Italian bonds surged amid signs that global inflation is becoming more entrenched. Lagarde last week set out the ECB's plans for a 25 basis point increase in rates next month. That's the bank's first hike since 2011, and signalled that a larger move is likely at its next meeting in September. And an ECB official said that the central bank has to address the fragmentation issue to ensure that monetary policy is effectively transmitted across the whole Eurozone area. And investors should not doubt the commitment of policymakers to deliver on their mandate to maintain price stability. They'll do whatever it takes. We've heard that before, of course. Central banks around the world are battling to show they can tame this rampant inflation after arguing for months that price surges were temporary. In Europe, the prospect of the ECB increasing rates for the first time since the sovereign debt crisis in the early part of the last decade is indeed stirring up concerns that the flaws in the currency bloc might again be exposed. The limited mechanisms for fiscal transfers between member states and the incomplete banking union means that weaker countries can come under pressure in periods of financial turbulence. Now, I think the ECB ought to have signalled the plan already at its scheduled meeting last week. That's certainly the view of many critics. This is a relatively quick course correction, but there is a cost in that the hurdle for market credibility is higher now for the ECB, and it's moving reactively rather than proactively, said Krishna Gur, head of central bank strategy at Evercore ISI. The blunders by monetary mandarins tarnish a reputation of ensuring price stability and preventing the kind of inflationary spiral that hammered middle-class incomes in the 1970s. This loss of credibility means even greater policy action may be needed to diffuse price pressures. Central banks are in a dilemma, said Sara Shari, a former Bank of Japan board member who's now a Keio University professor. To restore confidence, central banks need to raise policy rates sufficiently to bring down inflation, and that may lead to a further slowdown in the economic recovery, she said. Belief among households and companies that central banks will succeed in meeting their inflation goals over time helps to moderate price pressures. Households might hold off on some purchases, confident some prices will come down in time, and workers will be less likely to embed cost of living compensation demands in wage talks. Policymakers until recently highlighted that long-term inflation expectations were contained, a testament to their credibility. Federal Reserve Bank of Chicago President Charles Evans explained in March that current-day inflation wasn't like the 1980s because, quote, overly accommodative monetary policy in the 1960s and 1970s had contributed to the build-up of long-term inflationary expectations. But isn't that what they've just been doing over the last 15 years? And of course, last Friday's University of Michigan gauge of longer-term price expectations showed a major crack in the narrative, jumping to the highest since the 2008 oil price spike. So the Fed, the ECB and its peers cannot be blamed for failing to anticipate the price surges stemming from Russia's invasion of Ukraine, nor arguably the duration of global supply chain challenges, but continuing to expand their balance sheets in 2021 and to keep rates near zero even as inflation soared and economies recovered from the depths of the COVID-19 crisis now looks to have helped sow the seeds of the current turmoil. that I believe will deal a devastating blow to the credibility of central banks when investors realise that the inflation we face is man-made and central banks have played an instrumental role, said Stephen Gem, who runs Eurozone SLJ Capital, a hedge fund and advisory firm in London. Powell took until November to retire the description of inflation as transitory, and last month acknowledged that with hindsight, yes, it probably would have been better to have raised rates earlier. And of course, former Treasury Secretary Lawrence Summers has been a consistent Fed critic since early 2021, blasting the US central bank forecasters' March expectations for inflation as delusional when issued. The Fed's preferred price gauge rose an annual 6.3% in April. The median estimate of Fed officials in March was for 4.3% for 2022. Now, of course, the fresh forecasts are much higher. The US isn't the only one facing a credibility challenge. Lagarde and her colleagues are now on course to raise rates, and that's after Lagarde said in December that it will be unlikely there'd be any tightening this year. All international institutions, all forecasters of repute, have actually made the same mistake of underestimating the crisis, Lagarde said last week. And of course, the RBA Governor Philip Lowe in May said it was embarrassing that his previous policy guidance that rates would remain at a record low until 2024 had proved so wrong. And then he tried to rewrite history by saying, but of course we did caveat it back then, saying based on the assumptions that we had, and of course their assumptions were wrong. That's pretty cute, but not unhelpful, I think. Among emerging markets, there's a mixed picture. Some, like Brazil, hiked much faster than developed nations, and China has instead focused on offering monetary support amid an economic slowdown. But in India, the central bank pushed back against suggestions that they were behind the curve as recently as April, only then to go to raise its key interest rates 2 months in a row. And inflation, meantime, remains well outside its tolerance zone. And in fact, for many, polls are showing evidence of public loss of confidence. A Gallup survey released in May showed just 43% of those polled had a great deal or fair amount of confidence that Powell would do the right thing for the US economy. While not the lowest among recent Fed chiefs, it's well under the 74% Alan Greenspan got in the early 2000s. For the first time on record, more people were dissatisfied than satisfied with the performance of the Bank of England when it comes to controlling prices, according to a quarterly BOE survey. And the Bank of Japan Governor Kurudo has seen his popularity slump after he said consumers were becoming more tolerant of rising prices. A Kyodo News survey published on Monday found 59% deemed him unfit for the job. Stanley Druckenmiller, who runs a family office, this month warned that because central bank policy a year ago was totally inappropriate, it's inevitable that investors will lose money. If you're predicting a soft landing, it's going against decades of history, he said. And by the way, he managed money for billionaire George Soros for more than a decade. The dollar extended its losses on Thursday from a day earlier, but the pain isn't expected to last very long because wobbles in the global economy and Federal Reserve leaning more hawkish will push investors into the safe arms of the greenback. The US dollar index, which measures the greenback against a trade-weighted basket of 6 major currencies, fell by 1.2% to 103.64. The dollar has been supported by a double helping of Fed hawkishness and a wobble in the global economy, but there aren't signs that either of these conditions are shaping up for a reversal, likely signalling the dollar has further to run. Foreign exchange strategists expect the US dollar to remain strong. Neither a dovish pivot nor a marked improvement in global growth expectations appears likely in the near term, Morgan Stanley said in the note. And of course, the Federal Reserve raised that rate by 0.75% on Wednesday and has set a course for a far steeper path of rate hikes. The central bank now expects to raise rates by another 1.5% or 150 basis points to about 3.4% by the end of the year. That was far steeper than the Fed's prior projections in March, when it saw rates moving to about 1.9% by the end of the year. And Fed Chair Jerome Powell conceded that the central bank's hand was twisted into larger than expected hikes by inflation data that surprised to the upside, Some on Wall Street believe that Powell hasn't yet got a grip on how much longer inflation is likely to run hot. The bottom line is that the Fed still believes core inflation is largely temporary, Morgan Stanley said, pointing to the Fed's forecast of core inflation to peak at 4.3% this year and eventually drop to under 3% next year. And if the Fed finds itself staring down the barrel of inflation surprise once again, then it'll be forced to extend its forecast on how much further rates will need to move before peaking the so-called terminal rate to bring down inflation. The central bank currently expects to put its rate hike tool back into its monetary policy toolbox when its benchmark rate reaches about 3.5 to 4.5%. If inflation, however, continues to run above 8% for the rest of the year, as some market participants now expect, then the Fed may be forced to raise its terminal rate to 4.5 to 5%. And the longer than expected journey to peak rates will prolong the dollar's gallivant higher at a time when deteriorating growth expectations, Morgan Stanley says, is also proving fertile breeding ground for dollar bids. A reduction in investor growth expectations may strengthen the US dollar by impacting risk appetite. And just before we close, it's worth noting the Swiss franc soared against the dollar and the euro on Thursday after the Swiss National Bank delivered a surprise interest rate hike, while the British pound rose after the Bank of England delivered a rate hike of its own. The SNB joined other central banks in tightening monetary policy in its first rate hike in 15 years, increasing its policy rate to minus 0.25% from the minus 0.75% that it deployed since 2015. The move put the Swiss franc on pace for its largest daily jump against the euro since the SNB ditched its currency peg in 2015, with the common currency tumbling 1.9% to 1.019 francs. That's a 2-month low. The US dollar tumbled 3.1% against the franc, on pace for its largest one-day drop in about 6.5 years. There was always that room for surprise from the SNB, but I think most currency traders did not anticipate such an aggressive action from the SNB, and it was surprising, and it kind of set the tone for the dollar, said Ed Moyer from Onya. Most analysts had expected the SNB to hold rates on Thursday and flag a hike for September, although a couple of banks had predicted a 25 basis point move. This is one of those rare foreign exchange surprises when you could see significant momentum post this event, as the SNB seems likely to have further aggressive rate hikes to try to stabilise inflation, Moyer said. And sterling had a volatile day, initially dropping after the Bank of England raised interest rates by 25 basis points, confounding some forecasts of a bigger hike to fight soaring inflation, before the British currency reversed course to trade up 1.42% to $1.235. That's the highest versus the buck since June the 10th. The Bank of England said it was ready to act forcefully in response to indications of more persistent inflationary pressures. And against a basket of currencies, the dollar slipped 1.1% to a 3-day low of 103.66. That's the day after the Federal Reserve delivered its biggest rate hike in decades, but then tempered its outlook by telling investors that such sharp moves higher were unlikely to become common. The index remains close to the 2-decade high of 105.79 touched on Wednesday. Weak risk appetite will provide some underpinning for the US dollar, but we remain unsure of the US dollar's ability to gain significantly from here, Sean Osborne, chief currency strategist at Scotiabank, said in a note. The dollar was 1.3% lower against the yen, ahead of the Bank of Japan's 2-day policy meeting that ends on Friday. The Bank of Japan is one of the rare major developed world central banks yet to flag higher rates in a tightening cycle that started late last year. But the yen's drop to multi-decade lows has given weight to the idea the central bank could give in to global market forces, opening up a slim chance for a near-term tweak in its policy. So you can pretty much see, whether you look at the US, the UK, Australia, New Zealand, or pretty much anywhere else, interest rates are rising faster, way faster than central bankers were thinking about, and the inflation is also much stronger. So the question now is, how likely is a recession? Well, I must say that it looks more and more likely to me. But again, I guess we'll just watch the data and see where we travel. However, if household confidence continues to ease back and spending continues to go into reverse, then a recession is almost certain. I don't think central banks will be reversing rates very soon, but they are really caught. At some point, they may have to. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.